The Morgan Report with David Morgan.
Welcome to the weekly perspective for the week ending 16 August 2019. Well, I'm on the blog here on our website, just as a reminder that it's a place you ought to check probably a couple times a week. Also, the podcasts are on our main website. There's a pull-down menu that says blog podcast, and you can always retrieve them there. I'm just going to be verbal this time. I'm actually in Mexico. I don't have a lot of access to my normal tools to do a weekly update. Wanted to go over some really big picture things that I've talked about again and again and again and try to put them into a connected dot perspective. Number one, I've said for many times that the correlation between bonds and stocks has been gone for quite some time. And that's pretty easily provable just by looking at the long-term charts of the bond market and the stock market. So the safe haven status of bonds really a myth, although we certainly see a lot of influx into the bond market when there is concern in the stock market. It doesn't necessarily have the inverse relationship that it has had in past decades. That's number one. Number two is at the end of an economic expansion, or as it nears the end, we've always seen commodity prices start to inflate or go up in price. And that's because commodities are needs, not wants. A lot of stuff on the stock market's needed, but a lot of it's also wants. Consumer goods, clothes, all this stuff, some of it's necessary, but how much clothing do you need? There's a certain amount that's a need. Beyond that, it's want. I want to look good. I want to have this special whatever. So I don't want to digress too far. The point being that commodities are needs. They're food, agricultures, they're financials, of course. They're softs, which are your cotton, cocoa, coffee. And you've got your metals as well. And not all the metals, of course, are on the COMEX. There's your nickel and tin and many other exotics that are on like the LBMA, LME, and other exchanges. The point I'm making is this: when you are expanding, you are using more raw materials. And when you're using more raw materials and there's more demand for raw materials, that usually has some price effect, meaning more demand, certain amount of supply, prices are pushed up. Not happening. The last decade has been terrible for the CRB. If you look at the Jefferies CRB index over the last decade, from the peak in 2008 to present time, so more than a decade, as I just said, you'll see it's in a major downtrend. Even the agricultural commodities are on balance. So this is deflationary, and we haven't seen this in quite some time. So what this means is, as the equity market and the bond market are both seeing more and more pressure and there's more and more uncertainty, and we may be peaking, we look to the commodities to basically make up the slack, and they are not. So my premise that I have said again and again and again is in this next move, you will see the money metals, gold and silver, also probably platinum and palladium, move up, while you will see the commodity sector really not do that much. This is very bullish for silver from a longer term perspective, because if there isn't a commodity boom, and I certainly think there will not be, then the demand for copper, lead, zinc will be less than it is right now, which means that 70% of silver that results as a byproduct of mining activity will be curtailed, not to zero, but it will not be moving up. It will be moving sideways or downward. The last thing that anyone wants to see from a banking perspective is a deflation. It's very difficult for central banks to fight deflations. And the last point I want to make, and I'll wrap this up, is that I have said again and again and again, and if you take it to heart, that gold does best in a deflation, not an inflation. Everyone is conditioned to believe, and there's very good cases that can be made, that gold does well as an inflation protection. In other words, debasement of the currency. And I'm not going to argue that point. What I'm going to suggest is that gold does well in a crisis situation. And a deflation is definitely, or a major deflation could be a crisis situation. And deflation specifically was pointed out in the book by Roy S. Jastrom The Golden Constant, where he looked at gold vis-a-vis a basket of commodities going back centuries and proved in that book that gold does best in deflation. The only counter-argument I would make is that some of the time, and a lot of it actually, we were on a gold standard. So it's difficult to compare apples to apples when you're looking at what does gold do when it's the actual money versus what does gold do when it's not used as money and you're on a fiat system. Regardless, I do think that the money metals may move by themselves without the rest of the commodity sector, with the exception of the agricultural commodities. I'm still a big believer that the foodstuffs are going to be tightening in supply worldwide and that you will see pressure on food prices going forward. And this is something to keep in mind with your daily budget. Oil's a little trickier. I still think oil is going to move higher over time. I still think it's a good place to invest outside of the precious metals, but there's so many forces, especially geopolitical tensions, and it is probably the most political commodity out there, probably even more so than gold, although you could argue either direction. I'm not going to. So that's going to wrap it up for this week's weekly perspective. And I will be here on a somewhat of a vacation here in Mexico for 1 week. I'll be doing the next update vis-a-vis the internet and probably an audio only. Wish you all the best. Until next week, this is David Morgan signing out.
Hello, I'm David Morgan, publisher of The Morgan Report, and as some of you may already know, The Morgan Report is about money, metals, and mining. In fact, we cover all resources, from rare earth elements to precious metals. I've been publishing on the internet for about 20 years. My primary passion is to help people build and preserve their wealth. I love to make people millionaires. I've helped thousands of people via our research in The Morgan Report, which has thousands of paid members and 10 times that amount on our free weekly updates. Here's what you'll receive from our free newsletter: to-the-point webinars, weekly analysis of the financial markets, interviews and our conference schedule, special reports such as riches and resources, and various metals price forecasts. Our paid service client base is primarily small to medium-sized business owners, professionals in the industry, or the seasoned investor who understands markets and the value of precious metals. My area of expertise includes equity analysis throughout the resource sector, energy metals, base metals. We cover startups to billion-dollar corporations. We focus on a special sector that makes money regardless of price oscillations, and the importance of precious metals due to the ongoing currency devaluations. Our team of 3 analysts and support staff can help you build and protect your wealth. It's important for you to know what other people have said. We're passionate about what we do. High integrity and trust. Tell the truth and own it. If we're wrong, we admit it. Take a long-term outlook with major assets, and bet a little to win a lot with speculative situations. If you choose to become a client, you will gain financial insights very few, even professionals, recognize. You'll understand the importance of honesty in our financial system. You will understand how the money system influences almost everything in your life. You'll be prepared for the ongoing currency crisis. And finally, I've chosen to make my life's mission greater than the individual, which means my mission statement is to teach and empower people to understand the benefits of an honest monetary and financial system. It's been a great journey so far, and the best gains in this sector lie ahead over the next 3 to 5 years. I'm fortunate to have earned the status of being a leading authority in my field in helping others protect their wealth. You can email me at support@themorganreport.com or call my office at 480-325-0230.